Can you still run payroll comfortably? Can you avoid taking emergency debt? Hello there, Salim Omar here from Straight Talk CPAs. I'm joined by our senior advisor and CFO, Abhi. Abhi, welcome.
Hi, Salim. Thank you for having me.
Many business owners judge the health of their business by looking at one number, and that one number is their bank balance. If the number is high, they feel comfortable. If the number is low, they feel stressed. But the truth is, the size of your bank balance often tells you very little about the strength of your business. In fact, we've seen companies with millions of dollars sitting in the bank operating in a very fragile manner compared to businesses that have a fraction of that in their bank account. So the real issue, I mean, we've also seen fast growing companies run into serious stress simply because they didn't have enough of a liquidity buffer. So the real issue isn't how much cash you have, it's how your cash is structured.
Exactly. So, cash sitting in the bank account isn't really a strategy. It's just liquidity. It's just liquid money that's sitting in the bank account. And unless you know what that liquidity is protecting you from, or what the job that cash is supposed to do, it can actually lead to bad decisions. So, some businesses keep far more cash than they ever need. Others run the business with almost no buffer at all. And both situations create risk for that business.
Yeah, with what you just shared, I want to share an example with our viewers. We once worked with a US distribution company that had nearly 8 months of operating expenses sitting in a bank account, like 8 months. And they felt extremely conservative. They believed they were being safe.
But at the same time, they were carrying a line of credit at around 9% of interest. So that business had expensive debt while excess cash was sitting just idle, earning less than 4%.
Yeah, I mean, banks don't, if you money in a CD or something, it's a few percent.
So the owners believed they were being conservative, but structurally their capital wasn't working efficiently for them. So once we analyze their situation, the situation and the solution to that situation was actually pretty simple. 3 months of operating cash flow as a floor, 2 additional months just as a volatility buffer. Everything above that went directly towards reducing that high interest debt.
Yeah, and I remember this as a win for us because, and for the client, that one
Hmm.
structural change, improve their margins without increasing revenues. So these are kinds of
Mhm.
things that not necessarily come from revenue growth, but they come from structural changes. Same business, just better capital structure. And this highlights something many owners miss out on. Cash itself doesn't make a business safe. Liquidity discipline does. I want you, next, I want you to share the framework, the three jobs
Mhm.
that cash has to do.
So one reason owners get this wrong is that they treat all cash as just one big pile.
Hmm.
Just whatever happens to the sitting in the bank. But in reality, business cash actually has different jobs.
Yeah, and there are three buckets. We like to think of it as three buckets. The first bucket is operating cash. Second bucket is buffer cash. And then the third bucket is strategic cash. Why don't you go into talking about what operating cash is, and then we'll go into buffer cash and then strategic cash.
Operating cash is the very basic one: payroll, rent, paying to vendors, the basic cost of keeping the business running.
Yeah, and most business owners know that. They've been told that. Yeah, it's the obvious one that you want to have the operating cash one. But that's not savings, that's oxygen to keep the business alive, to keep the doors open. So if your fixed operating expenses are, let's say, 120,000 per month, that money is already spoken for. It's simply the cost of keeping the engine running.
Hmm.
Let's talk about buffer cash.
So the second one is buffer cash. This is what protects the business when something, let's say, unexpected happens. Customer payments get delayed. There's a slow quarter that hits the business, or the market suddenly becomes highly volatile.
Hmm.
Practical starting point for many businesses is about 3 months of operating expenses. Below that level, things can get uncomfortable very quickly.
Third bucket is what we call strategic cash. It's the third category that many business owners don't think about. Yeah, strategic cash one. This is the capital that allows a business to move when opportunity appears. For example, maybe a competitor is becomes available for acquisition. Maybe
Hmm.
suppliers offer significant discount if you can purchase inventory early, or maybe you want to invest aggressively in marketing when competitors are pulling back.
Businesses without strategic cash often miss all of these opportunities that you mentioned earlier, or they end up borrowing at high interest rates under pressure. And that's where the opportunity cost becomes real. Strategic cash isn't just idle money that's lying around, it's optionality. It gives the business the ability to act when right opportunity appears.
Now let's look at the opposite problem. We also
Mhm.
see businesses growing quickly but operating without almost no liquidity buffer.
Yeah, exactly. So we worked with a business that was a service company growing about 30% per year. Revenue looked fantastic, but they had barely 1 month of operating cash.
Yeah, and then what happened, Abhi? Two large clients delayed payments by 60 days, which in the US is, I mean, that's unusual.
N- not unusual. So suddenly everything tightened. Payroll pressure increased. They had to take short-term loan, and they even started discounting invoices just to accelerate the cash flow.
Yeah, nothing was really wrong with the business model. The issue was
Mhm.
liquidity discipline. Yeah, they had 1 month of operating expenses and nothing in the buffer, and growth without a buffer creates, a business that's fragile.
Yeah. So here's a simple exercise most owners never do. Ask yourself one question. What happens if the revenue drops 20% for 1 quarter?
And I want you to ask yourself this question, not theoretically, operationally. Can you still run payroll comfortably? Can you can you avoid taking emergency debt?
Or does everything start feeling tight immediately? Because if a single slow quarter destabilizes the business, that's not just a growth issue, it's a liquidity structure issue.
And strong companies design their finances
Mhm.
assuming volatility will happen, not
Mhm.
assuming that everything will go perfectly. And there's another misconception here. Many business owners, entrepreneurs, they believe holding as much cash as possible is the safest approach.
And sometimes it is the safest approach, but sometimes it's actually avoidance. Avoidance of making capital allocation decisions. And there's another subtle risk. Excess cash can create complacency. When the bank balance looks healthy,
Hmm.
inefficiencies often go unnoticed. Costs drift upwards, capital sits idle, and decisions get delayed because the urgency disappears.
Yeah, and meanwhile, if the business is carrying debt at 8 or 9%, that idle cash can actually be destroying value. So the goal isn't maximum cash; it's optimal liquidity, enough to absorb shocks, volatility, but not so much that capital stops working.
If you want a simple starting point, here's something you can calculate quickly. First, determine your monthly fixed operating expenses.
And then multiply that by three, and that becomes your minimum liquidity floor.
From there, consider the volatility of your specific industry. Some businesses may need 4 or 5 months of reserves. Others may be comfortable with just three.
All right. So I'm glad you kind of mentioned that and clarified that point. So really depends on the volatility of the industry. Yeah, it could go from 3 to 5 or even more. And along with that, I want you to ask one final question. Is the account, is the cash in your account the result of a deliberate policy, or is it simply leftover cash?
Liquidity isn't about comfort, it's about confidence. Knowing the business can absorb the pressure without forcing bad decisions.
When your liquidity structure is intentional, a lot changes. You negotiate better, you avoid emergency borrowing, and you invest more strategically.
Most importantly, you stop running the business based on whatever happens to be in the bank. You start running based on a specific guided plan.
Makes sense. Because strong businesses, I mean, they aren't defined by the size of the bank balance, they're defined by
Mhm.
how intentionally their capital is structured. And disciplined businesses build structures that allow them to endure. Thanks, Abhi, for sharing your insights, your experience working with our clients. I hope viewers found this episode very useful. Our business owner, clients, prospects, and so forth. Um, if you're watching this and you found this valuable, please like it, share it, and look forward to seeing you on the next episode, Abhi. Thanks.